Hey everybody, welcome in. Today we're going to talk about why the 2026 oil market is already locked in. So it's already set, the future is set, and it's based upon a few factors. And I am going to talk about those factors and what it means for the oil markets in 2026. So let's already talk about it. 2026 is already locked in and almost nobody sees it. So what is happening? Why am I saying this? Everyone thinks that 2026 depends on geopolitics. It doesn't. That it depends on decisions that have already been made. So these have already been in motion for the last year and a half, probably since 2022 when Russia invaded Ukraine, and that throttled commodities, specifically energy commodities, into a new stratosphere. So after that period, we went through a demand shock, a supply shock, and now we're kind of resetting the table. So the oil market in 2026 is going to be largely determined by decline rates that is already baked into existing production, and I'm predominantly talking about the US because they've added so much production over the last 10 to 15 years that they are one of the leading global players when it comes to oil supply. Capital decisions, which have already been made, these have been already set. Capital decisions at companies like EOG, like Devon, these have already been taking place over the last 3 months. And over the last 3 months, what have we had? We've had crude oil prices for 2026 looking into the future at $60, and now it is probably mid $50, so about 55. Lastly, large cycle project gaps, and these cannot be reversed quickly. These have a 5 to 10 year horizon, and these have been in a state of flux over the last, I'd say, 10 years. So even if prices spike tomorrow, the supply response window does not reopen in time. And I'll explain what that means in a second. So when we look at the US supply treadmill, if you watched last week's video, we talked a lot about supply and how much we decline. So every month, the United States declines over 650,000 barrels a day versus the last month. So if we're producing 13.8 million barrels a day, which is what we're currently producing, if we do not bring on any new production in January, we will produce 650,000 barrels a day less, or 13.15 million barrels a day. So that would be January's production, not a daily production. I'm quoting a daily figure, but it equates to roughly 20,000 barrels a day of decline. I think 20 to 25,000 barrels a day of decline every single day that we don't bring on a well. Now, we do bring on wells. So what we track over here at Energy Rogue is we track what the new production is, what the decline is, and then we put them together. And that's what you'll see in this chart. And what you'll notice on this chart is that the scale goes from 40,000 barrels a day positive to minus 10,000 barrels a day negative. What does that mean? That means for November, we actually declined by 10,000 barrels a day. So in October, we say produced 13.81 million barrels a day. In November, it would be 13.8. Now, that may not seem like a lot, but what I'm trying to say is if we don't add 660,000 barrels a day of new production, we are going to decline by whatever that number we fall short. So every month we would decline. So what that means is if we didn't bring on any new wells, which won't happen, but if it did for 10 months, you're talking about 6.5 million barrels a day that would disappear from the supply base. We're taking us down from 13.8 million barrels a day, almost to half. So that's what would happen with no supply basis. This is the reason watching rigs, monitoring rigs, rig productivity, the drilling productivity are key metrics, and we track all that over here at Energy Rogue. Now, here's the decline math. This is the killer. The U.S. shale declined 600 to 700,000 barrels a day of each month. To grow production by 200,000 barrels a day year over year, the industry must replace 7 to 8 million barrels per day of declines annually. So annually, that is a lot of drilling rigs. That is a lot of productivity. What this means, growth is no longer about expansion. It's about running faster just to stay in place. This is the treadmill effect. And if you've ever been on a treadmill and you raise the angle, that's what we're talking about, is new production accelerates how much production you need to replace. So that is a little bit about that. And to give you kind of a visual um, on that, when we're looking at the net, you can see this goes back to February 2021, and this started every month we were adding 120,000 barrels a day. And that has been on a steady decline. You can see a big drop 21 to 22. This is legacy COVID issues. Then we rebounded predominantly because price responded and we went way up when Russia invaded Ukraine. But what's happened since then? We've seen a continual decline in how much production we're seeing on a net basis. So when you look at declines and you add in new production, we're right around the zero line. This is where we've been. And if you look at it a different lens right here, I'm going to look at this one. It will load up in just a second. There we go. This is something, and what I'm using here, this is our platform Rogue Edge, and this is $179 a month if you're interested in oil markets or natural gas liquids markets, or refined products. We do have a 14-day free trial, and it's just at the link in the description below. But what was my point here? Here we go. So let's go back to January 2024. We were producing around 13.3 million barrels a day. Now we're entering January 2026. So that is 2 years. Over 2 years, we've grown 600,000 barrels a day, or 300,000 barrels a day each year. And what I'd say is, during this time frame, oil was probably, I'd say, plus 10 to $20 higher. And most of 2025, this period, oil was at least $10 to $15 higher. So what that means is the forward, we are about $10 to $15 lower. That means a slowdown in rigs, which means a slowdown in production, but we haven't seen it yet. So productivity is rising. Each well is producing at a higher rate, but at a cost. Yes, these wells are more productive, but productivity gains now require longer laterals, which mean they're more expensive, higher proppant intensity. What that means is the materials that they thrust into the ground to fracture the rock. That is actually an added cost. More complex completions, and these are adding completion costs and a higher service cost. So what that means is higher break-evens, higher reinvestment requirements, less flexibility at sub $70 prices. The US shale is no longer elastic at $55 to $65 a barrel. So add in capital discipline, it's structural, not cyclical. This is where people underestimate the permanence of this shift. Post 2020 behavior change. Producers learned 3 hard lessons. Growth destroyed their equity value. They were outspending, and over the last 10 years, over the last 10 years, we've seen kind of a growth expansion, contraction, bankruptcies. We've seen a lot of bankruptcies, and growth destroyed that equity value. Investors punished volume first strategies. They did not reward volume, they were rewarded profitability. So cash flow matters more than barrels. That means there's a harder lens. Over the last probably from 2005 to probably 2017, 18, it was a race for volume production and with monetary capital discipline being secondary. As a result of these shifts, we've had a free cash flow. It exceeds growth in volume. Dividends and buybacks is more important than rig adding or adding rigs or adding volume. And balance sheets are more valued than market share. So it's not sentiment. This is governance. This is capital discipline. So OPEC has learned to wait. This is another variable. This is one of the most underappreciated shifts in the market. The old OPEC defended price, chased stability, and offset U.S. growth aggressively. The new OPEC allows the volatility, observes the U.S. response, and uses time as leverage. Right now, there's about 1 million barrels a day of spare capacity. Some argue more. I value it somewhere between 1 million barrels to 1.5 million barrels. That's in line with what they've cut. And a lot of people throw around spare capacity numbers. We actually evaluate what they've produced in the past. So what we typically look at is when you scroll down here, here's what we actually evaluate is we compare what OPEC has produced in the past at different price points. Back in 2018, 2019, we were pushing $100. All right, so we were producing a lot higher. Here, we're producing a lot more, and this is recovery after the voluntary cuts. So a lot of this is in lower prices. I mean, we're at $55 right here. So what I don't see much spare capacity coming back online. So the OPEC and OPEC plus decisions, they now understand the U.S. won't grow supply at low price points. So what does this mean for long cycle? Long cycle projects are missing, and these can't be rebuilt fast. Between 2015 and 2022, global upstream investment fell 30 to 40% below replacement levels. Okay, so there's spare capacity, which is capacity that is constrained. You can think about it as a drilled well that is just waiting to be turned on the valve. It's not that simple. There's a lot more to that, but you can think about it that way. So right now we're below that replacement level place. And that means if demand shifts, we are going to have a massive price response. Large offshore and conventional projects were delayed or canceled. Discoveries hit multi-decade lows. What's the key point? Key point is these barrels don't come back on, don't come back in 6 months or even 12 months. They take 5 to 10 years. They take political certainty, which is something that is in rare supply right now. Stable pricing, which is also in rare supply right now. 2026 sits squarely inside that gap. So demand doesn't need to boom to break the system. This is where most forecasts go wrong. The market doesn't need explosive demand growth, a Chinese supercycle, a geopolitical shock. It only needs demand to stop being so weak. And it is weak, it is masking underlying economic problems that we have in our economic global structure. Even a return to trend demand growth, normal travel, or modest industrial recovery. So it just has to move a little bit. So inventory is giving a false sense of security. Inventories are a lagging indicator, a cushion, not capacity, and markets will price what could be supplied, not what exists today. Once inventories begin drawing without a production response, price must do the work. That's when volatility turns vertical. So why the price will be violent, not gradual. Oil doesn't reprice smoothly when spare capacity is thin. Supply price is inelastic. Demand is inelastic in the short term. Instead, the market underprices the risk, waits too long, then overcorrects. That's what we saw in 2022. What this creates is fast repricing, curve inversion, panic hedging, violent backwardation. This is exactly the environment where $10 to $20 moves happen very quickly. In summary, the oil market of 2026 is already locked in, not because of forecasts, but because the decisions that determine supply flexibility have already been made, and reversing them takes more time than the market has. Now, I'm going to sum up with some of the narrative that you've probably heard of out in the marketplace. Crude stocks are not as low where they were a year ago. That's surplus risk. OPEC Plus has 1 million barrels a day to bring back online. Demand doesn't really show a path through recovery. Product stocks are indicating weakness. And a lot of the forecasts out there, IEA is projecting a 4 million barrel a day surplus. I'll tell you, if that happens, we are talking $10, $20 crude. I don't think that that is reality. I think OPEC's predictions are a little bit closer in line. So, what are the bullish and bearish for WTI and Brent? Bullish factors are 2025 demand was better than expected. India is showing solid growth. U.S. refinery inputs are hitting new highs. U.S. Venezuela tension, there is some geopolitical impact. Iran, Hamas, Israel tension, there is some geopolitical tension. Those are increasing the bullish factors. On the bearish side, economic indicators are weak. China is importing 1 million barrels a day that it doesn't need. It's filling its strategic petroleum reserve. They're building it as they're importing it. Gasoline and diesel are still, the demand is still meh. Russia-Ukraine peace, when that happens, fundamentally, that doesn't change. Those barrels are hitting the market today. There's not going to be a magic switch where new Russian barrels are going to come online. Ain't going to happen. So Russia-Ukraine peace actually just means that there's going to be a resolution and there's going to be more economics going back to Russia as part of that peace. So demand is showing signs that it's tapering off. So listen, there's a lot of factors out there. We at Energy Rogue, we take this very seriously. We have 2 products out there that can help you on your mission. If you follow oil and gas markets, we have 2 products, Rogue Radar and Rogue Edge. Most of these are replacing institutional solutions that cost $20 to $30 to $40,000 a year, and we put this into an affordable package for Rogue Radar, which is for the basics, and then Rogue Edge for people that need to get in a little bit deeper. And to give you insight into this, Rogue Radar, we issued, let me go to Crude Radar, because we do this for crude, we do this for gas. So every day this is updated, and I issue my thoughts, today's update, the market summary, technical analysis, fundamental analysis, supply, demand, storage, stocks, international price analysis, OPEC, CFTC, news analysis, economic analysis, because it does track economics, Fibonacci, machine learning price, and an AI analysis to predict the future. So listen, what I would say is you don't have to come subscribe to us, but if you or your business depends on the price of oil, the price of natural gas, price of refined products, price of natural gas liquids, we have customers from around the world that are in those businesses that come to us as an alternative versus spending 30 plus hours a week in researching this or spending $50,000 or more in research. So listen, thanks for joining. Drop us a comment. Let us know. I'm thinking about doing gas next week. Let me know in the comments if you want to hear about natural gas for 2026. But that's where we are for 2026 on crude. Most of this is already set. My personal bias, and I'm not a financial advisor. You can read the disclaimers down below. My personal bias is that we're going to be lower to start 2026, second half of the year. If demand holds up, we could see fireworks. So listen, thanks so much. Hope you have a great day. Talk soon.